Inflation data was released today on Thursday, June 11th. Monthly data fell 0.1% in June. And annually, the CPI is now at 3%, down from 3.3% in the previous month. Gold reacted by going up 1.6% on the day. Stocks are down, with the S&P 500 down about 0.8%. Tech is leading the charge downward with major sell-offs in Nvidia, for example. And the markets are now pricing in a significantly higher chance of a Fed cut by September. The CME Fed Watch tool is reading an 85% chance of one cut by September. What's the market outlook overall? Factoring in today's data, we're going to be talking about this with Brett Heath, CEO of Metalla Royalty. If you haven't already, please subscribe to my upcoming newsletter. It's completely free. It's just another way to consume content. If you don't have time to watch 30 minutes or an hour of interviews every single day, I post once to twice a day, then you can just read the summary recap, which will come out on a weekly basis. Plus, it'll be recaps of the week's top news, plus news to watch for the following week. It'll be very informative. Link down below on the Substack. Subscribe now, put your email in, and be one of the first to receive the first issue coming out later this month. Brett, welcome back to the show. Good to see you.
Thanks, David. Glad to be here.
The major news of the day is, of course, inflation. It's up only 0.1% on the month, down from 3.3% on the year to 3%. Now, the markets are reacting by the stocks going down. We can talk about that. And gold has gone up. So let's start with gold first. Gold is up 1.7% as we speak, about 2 p.m. Eastern time on Thursday. That's a huge jump, Brett. What happened to gold?
Well, what we saw CPI, slightly come down. I mean, PCE still holding in there, kind of basing. But what happened, I think, that made gold jump was there was a significant jump in the probability of a fake cut, of a Fed rate cut. So inflation coming down closer to their targets, that gives the Fed the opportunity to potentially have a cut. I think it'll still probably maybe only be one or probably maximum two this year. And I think they'll be fairly short-lived because I think that inflation is going to continue in the latter part of this year, kind of in the face of these cuts. And that's what gold is signaling.
Now, I've heard the view, Brett, that if the Fed doesn't cut by September, it's already going to be too late for the economy. By then, if they don't cut, it's going to signal just tightness for too long, and businesses, especially the small businesses, are going to go bankrupt. What's your view there?
Well, the economy is weakening. There's no doubt about that. I mean, you're seeing that in various different economic indicators, and when you look at M2 and you look at kind of M2 coming back, everyone was predicting a recession, but there was just so much liquidity in the system, it never even made it back to kind of the mean of that trend line. And so, we're seeing M2 start to increase. It's starting to base, starting to go higher again. And I think that is in response of kind of the Fed in preparation of a potential rate cut again in this fall, to starve off some of these things that you noted of the economy weakening.
I feel like I'm living through an episode of the Shepherd That Cried Wolf, right? Because earlier in the year, the markets were pricing in 6 rate cuts. We didn't get any. And now it's like, okay, now there's an 85% chance of a cut in 2 months. Yeah, right. That's what I'm thinking.
Yeah.
What do you think?
I think that the Fed's going to have to do something this year. So we probably get one cut, but it's probably short-lived. I think on the back of any cut, you're going to see a significant bump back in inflation in PCE. I think you're going to see all of the inflationary metrics start to rise again. I mean, if inflation comes in waves, it's not a linear type of activity. And so, we had a big move of inflation. Things have kind of cooled down. The Fed raised rates. The economy is weakening. So things are coming back down. There's a lot less of that liquidity that was in the system. Like if you look at a way that the Fed has been pulling liquidity out using the reverse repo market, that's been basing. They really haven't been pulling out a lot of liquidity the last few months. And so that kind of tells you, I think, that they're getting ready to do a cut. I mean, it seems like they're in more of a reactionary type of phase, but it looks like they potentially are.
Analysts at Citigroup, though, have predicted that once the Fed starts cutting, they're going to cut by up to 200 basis points in their next 8 meetings through the summer of 2025. I'm sensing you don't agree with that because you said that it's going to be a short-lived cut. What do you think?
I think that there's still a lot of liquidity out there. I think we will see inflation move into its next wave, and I think we're going to see inflation exceed the previous high, which was running around kind of 8 to 9% range a little ways back. And so if we get that type of inflationary data and those inflationary pressures on the back of any type of rate cut, the Fed will have to reverse. And I think that the market is not anticipating this. I think that the market's anticipating that the rates go back down to zero, and I just don't think that that's going to happen.
Okay, well, let's talk about that. So inflation is going to return to their upper range. Why is that? Why is inflation going to return?
Well, David. There's still a ton of liquidity out there, and when you look at M2, it's turning back up. When you look at if there's rate cuts, if we get into another phase of increasing the liquidity in the system, it's going to respond. And the gold is the best measure of this. And you look at gold on a day like today, it's almost back up to all-time highs. I mean, if it breaks out to all-time highs, we could probably see it rise another $100 pretty easily. So when you look at gold, I think that is going to signal what's likely going to happen in the future in the next 3 to 6 months.
Okay, let's go back to gold then. Gold went up today. Again, why? Because I thought, and me and other people as well, I thought that gold was an inflation hedge. Well, at least that's one of the ways it's being marketed in the past. With inflation having come down, are you surprised that gold is hitting new highs?
No, not at all. Because again, I think gold's very forward looking. So what gold's doing is it's predicting of probably what we're going to see in the next 3 or 6 months in advance. And so that's when I look at gold. If gold was coming back down to 2000, or if it was breaking 2000, then we'd have a different approach on it. We'd probably be saying, okay, well, maybe there's a much larger recession, or some type of liquidity event in front of us. I mean, that still may happen, but when you look at the price of gold and really how reactionary the Fed has been to any type of event, meaning very significant amounts of liquidity pushed into the system in a short period of time, I think that gold is basically signaling what's going to happen in the future.
Gold has done very well. The miners, for the most part, in the last 12 months have not caught up with gold. Why is that? Let's start there. We can talk about specifics.
Yeah, it's a very interesting phenomenon to see the divergence, not only in the equities, but also the kind of physical metal proxies within the market. But what we've seen, what I believe we're seeing is a lot of the capital is getting sucked up into big tech, and we're seeing outflows. When I look at the GDX and the GDXJ, which are the two largest ETFs for the gold equities, we've seen respectively 50 million and 110 million of outflows in the last 30 days, and respectively 145 and $1.34 billion of respective outflows in the last 3 months. These are the two biggest gold ETFs. So it just shows you capital, even in the midst of gold moving higher, capital is still coming out of this industry. And this industry is pretty small. So these types of numbers can make a material difference, where a few $1 billion is going to make not much of a difference when you're looking at kind of the big tech or any of the market leaders that are out there today. And similarly, when you look at GLD, and when you look at GLD back to its inception, the holdings of GLD has always correlated somewhat with the gold price. As the gold price goes up, the holdings will go up, more people will buy gold. And what we've seen in the last 6 months is a very significant divergence, where we've seen $2 billion of outflows out of the GLD, which is the largest gold ETF in the public markets. And we've seen gold move up over 20%. So what it's telling me is that the investing public, whether it's institutional or retail, are just not in these equities or interested in these equities at that time. And a lot of them have just incredibly compelling valuations right now.
I like talking to you because you're the head of a royalty company, and being a royalty company, you've worked with a lot of different projects from all over the world, because that's what a royalty company does. We can talk more about that business model in just a bit, but let's just take your stock, for example, as an example, right? MTA currently flat year to date, right? It's gone up, it's gone down, but year to date, it's about 0%. Gold is up 17%. What would you do to convince shareholders that this is still a good value and that eventually it's going to turn around? What's your message?
Well, our business has always been built for the long term, and so our focus since the very beginning, since inception 8 years ago, was to build a very high quality royalty portfolio that was based around the most proven geological trends and the largest operators in the safest jurisdictions. And so we went out and we picked up over 100 of these royalties. The majority of these royalties are being advanced by the largest mining companies in the world, and a lot of these assets were in development. We're very heavy development type of company over the last 8 years, just by that was our angle to be able to get exposure to these really great assets. And so right now the company is at I believe at an inflection point, because a lot of these assets that we bought that were in development are now coming online. We just saw one of our newest royalties come online within the last couple of days. That was a royalty on Tocantinzinho. This is going to be the third largest primary gold mine in Brazil. And we also have another three that we expect to come online in the next 12 months, and another probably 5 to 10 in the next 3 to 5 years. So as the profile of our company changes and the cash flow starts to really ramp up over the next 1, 2, 3, 4, 5 years, I believe that it's going to be a very attractive risk reward opportunity for investors looking at getting that free carry, non-dilutive interest exposure, which is what a royalty provides. We don't have those cost pressures that the mining companies do. So if gold goes from 1,800 to 2,400, we get that entire margin basically to our top line. Where when you see the gold price typically move from 1,800 to 2,400, the mining companies, their margins expand, but the costs always come up. And it might be 3 months later, 6 months later, a year later. But typically when you see these big advances with gold, the costs follow it. And with royalty companies, you get that 100% margin. So our shareholders are positioned, I think, very well with all of this growth that's been bought and paid for. And it was bought and paid for when gold was between $1,200 and $1,800 for the most part.
What are the miners doing with gold above 2,400? Let's start with the producers first. Presumably they have more cash, right? From the people you've talked to and worked with, what are they doing with this cash right now?
Right now, they're paying dividends, they're buying back stock, they're not investing that much of it back into new projects, new exploration. That's what really they should be doing right now. But investors have really pressured particularly the majors and the big mid tiers into returning capital, and I don't blame them for that, because historically the sector has not been the best steward of capital. But at the same time, mines are depleting assets, and if you don't invest in the future of those mines, or continuing to drill and explore, at some point these mines just will shut down. And that's really what we've seen over the last 3, 4 years. We've seen a big push in M&A. And a lot of that M&A was driven on the fact that these big mining companies have not been able to replace the reserves. And so how are they maintaining that growth? How are they maintaining these production profiles? And it's through mergers and acquisitions. And so the sector has kind of become a bit smaller and smaller, or at least more highly concentrated. We're also seeing that in the royalty sector. There's been a big M&A wave. We obviously did an M&A transaction last year, and I think that trend is going to continue.
Right. That was my next question. M&A activity this year seems a bit quiet compared to previous years, despite the fact that gold's at $2,400. Why is that?
Well, I think it'll pick up. I mean, normally most of the M&A activity that we've seen happens in the second half of the year for whatever reason. And we have seen some M&A activity, particularly around copper. I think that not only the big diversified companies, but the big gold mining companies completely understand the setup with the very well documented supply deficit with copper over the next almost decade or two. And also every single year that goes by, we seem to have a new source of demand for copper. It's a very, very strategic asset. That's why we merged with Nova Royalty and gave our shareholders exposure to 5 of the largest 10 development assets in copper in the Americas last year. So that's been a lot of, and we've seen that with BHP trying to buy Anglo American last year, Glencore and Teck. There's been a lot of this M&A, and a lot of it, again, has been driven around these big companies trying to figure out how they're going to give and basically ring fence their copper exposure for this next decade.
Wait, so is M&A happening more in the base metal sectors than gold?
Right. Recently, that's what we've seen. We've seen a lot of either M&A or attempted M&A around copper as a specific commodity. And these big companies, because these big companies realize that these big copper assets, they take 20, 30 years to go from discovery to production. The lead time is very, very significant. And as we go into this supply deficit, it takes that much time to bring a new copper mine on. So there's very, very few projects that are ready to be built today. And so and even fewer that are in production. So it's really a race for these companies to be able to kind of get that exposure. And once they get it, then they're good for quite some time. These mines go for oftentimes 50, 60, 70 years.
I'm just trying to think from a valuations perspective. Is it, correct me if I'm wrong, but is it generally speaking lower cost to produce or mine copper than it is to extract high grade gold?
It's really asset specific. Copper only seems to work with very, very large assets. There's been a lot of smaller copper mines that have been tried to be built. They all seem to run into a lot of trouble. The big, successful money-making copper mines are these mega deposits, and these are the ones that typically have the scale to lower those costs to make them very profitable.
Well, let's circle back and end on the markets now. The general sentiment of investors, what do you think they want right now? I know that's a very open-ended question. A couple of years ago, we were talking about the business cycle and sentiment. We were talking about cryptos a lot. That was the craze. Bitcoin has broken new highs this year, yes, but it seems to be getting less attention from the media than 3 years ago, right? And so tech, AI, we talked about. Is that it? Is that the only theme? What happened to cryptos? What happened to smaller names in the tech sector?
Yeah, I mean, right now it seems that the market is just consumed with AI. When you look at the representation within the S&P, you've got 30% of it is basically tied up in seven massive tech companies. And when you look back historically, that's only happened two times in I believe the last 100 years, which one was the tech bubble in 2000, and the other one was back in I believe like 1929. You have to go all the way back then to see kind of that heavily weighted. Obviously, the companies were a lot different back then, so it remains to be seen if that's even relevant. But that's where all the capital is flowing right now. When you look at the Invesco QQQ, one of the largest tech kind of centered ETFs, that's seen 10 billion of inflows in the last 3 months. But even Bitcoin, I mean, Bitcoin had a big move. I think it had a big move off of the new ETFs. I mean, when you look at the BlackRock ETF, which is now the largest ETF holding Bitcoin, that's had 500 million of inflows in the last 30 days and over 3 billion of inflows just on its own in the last 3 months. So these are still significant inflows that are coming in as opposed to what's happening in gold, or at least the GLD. But gold's being driven by the central banks. When you look at the first quarter, central bank purchases was 289 tons of gold. That's $23 billion or so of gold. We'll get the data for Q2 here shortly, but I wouldn't be surprised if it's probably going to be a little bit less than that, but I wouldn't be surprised if it's pretty close. And when you look at gold as a percentage of reserves for emerging market countries, when you look at India, China, Japan, Saudi Arabia, Brazil, Mexico, and so forth, all of these countries, their percentage of gold as their total reserves is less than 10%. A lot of them are less than 5%. And when you look at gold as a percentage of reserves from US, France, Germany, Italy, it's over 60%. So I think this trend is going to continue. The world still understands that the US the US has to refinance $17 trillion in the next 2.5 years. Very, very significant amount of capital. And most of that is coming off at 50 basis points and it's getting refinanced at 450 basis points. That will drive the interest expense, I believe, well over $1 trillion. And we're going to continue to see central banks drive gold higher. I think we could potentially see 26 to even up to $3,000 of gold within the next 12 months.
Based on central bank buying, continued central bank buying, Brett?
I think continue central bank buying, and at some point in time, we're going to see these inflows reverse. Now, the entire investing public today is selling gold equities, is selling gold. So what happens when the central banks are buying, and then all of a sudden the investors, whether institution or retail, start buying as well. So that's gonna put a lot of upward pressure on gold. I think that that's going to allow it to rise probably much faster and much farther than most people are anticipating. And it just goes to show that there's very few people in this trade today, and it's almost hitting all-time highs again.
Okay, I have to finish off on silver. Silver is something that moved a lot. So it was at about $22 an ounce earlier this year in January. It's at 31 now. So about a 50% move in the last 5 months or so. What's the silver narrative?
Well, silver, with silver, I always just look at the silver or the gold to silver ratio. We saw that break. We saw that break when silver kind of moved up through $30. It since then corrected. It kind of went back and tested that trend line, and now it's looking to advance again. So I think silver is poised for a very significant run in the very near future. Particularly if we see gold see new highs, I think we're going to see a very significant run in silver. The setup is there, and when institutions come in, when you look at gold as a percentage of total global wealth. That's this all the gold above ground, this physical gold, physical silver as a percentage of total global wealth. It's still only 2, maybe 3%. So what's going to happen is as those flows start to reverse, and we're going to see more flows into gold equities as the price continues to go higher, as we start to see maybe some of this capital start to outflow out of these big tech names. I mean, there's trillions of dollars in these basically wrapped up into 7 companies. So when that starts to reverse, like where is that going to go? Well, it looks like it's going to go into commodities. There's only so much gold above ground. Gold's going to move first. Silver is going to move first. And I think these equities are going to move on the back of it. And I think companies like Metalla that have a non-dilutive free carried interest into all of this gold, then they're going to do very well. Metalla currently has approximately, our royalties cover about 1.7 million gold equivalent ounces, and our market cap today is about 260 million US. So there's a significant opportunity there, I think, not only for the royalty companies, but also for the mining companies on the back of that move.
All right, good stuff. Thank you very much, Brett. Thank you for your time. And where can we follow your work, Metalla Royalty?
Yeah, our website, metallaroyalty.com, and you'll find all of our assets there and our company and our recent news.
Okay, we'll put the link down in the description below. Thank you very much for your time, Brett. See you next time.
All right, thanks, David.
Thank you for watching. Don't forget to like and subscribe.